Welcome to Finance Fundamentals. In the next 15 minutes, I'm going to walk you through the most important concepts in finance, the ideas that drive everything from your personal savings to Wall Street. No jargon, no fluff. Let's get into it. Finance has a reputation for being complicated, and a lot of it is made complicated on purpose. It's how financial advisors justify their fees. But the core ideas, there are maybe 13 of them. And once you understand these, you understand 90% of how money works. Let's start with the single most important one. This is the single most important idea in all of finance. A dollar today is worth more than a dollar tomorrow. Why? 3 reasons. You can invest it, inflation eats away at it, and there's always a risk you never get paid. This one formula, future value equals present value times 1 plus the rate raised to the number of periods, this drives everything. Loans, mortgages, stock valuations, retirement planning, all of it comes back to this. Compound interest is interest on interest, and over long time horizons it creates exponential growth. Look at these numbers. $10,000 becomes over $200,000 in 40 years at 8%, and that's without adding a single dollar more. Quick mental shortcut, the rule of 72. Divide 72 by your interest rate, and that's roughly how many years it takes to double. At 8%, that's about 9 years. The takeaway? Start early. Time is your biggest advantage. Here's the deal. There is no free lunch when it comes to return. If you want higher returns, you have to accept higher risk. A savings account is safe, but barely keeps up with inflation. Stocks return more, but can drop 40% in a bad year. And here's the thing. Risk isn't just about losing money. It's about volatility. Can you watch your portfolio drop by 40% and not sell? Because if you panic sell at the bottom, your actual returns will be way worse than the market. Your temperament matters more than your strategy. Diversification is the only genuine free lunch in finance. You can actually reduce your risk without reducing your expected return, just by spreading your money around. Don't put it all in one stock, one sector, one country. But here's the nuance. Diversification protects you from one company going bankrupt, but it doesn't protect you from the entire market dropping. For that, you need time. If you have 20 plus years, a market crash is just a sale. If you need the money next year, even a diversified portfolio is risky. Opportunity cost is the most underappreciated concept in personal finance. Every dollar you spend is a dollar you can't invest. That $50,000 car, invested instead, it could be worth over $200,000 in 20 years. Now, I'm not saying never buy a car. I'm saying think about the true cost. The small daily expenses aren't the killer. It's the big recurring costs that people never question. The car payment, the apartment that's 30% more than they need, the subscriptions that add up to hundreds a month. Inflation is the thing that makes cash a terrible long-term investment. At just 3% a year, which is roughly the historical average, your money loses about half its purchasing power in 20 years. That $100, it only buys $55 worth of stuff 2 decades from now. This is why you have to invest. Just holding cash means you're guaranteed to lose. Your investments need to beat inflation just to break even. A 10% return with 3% inflation is really only 7%. Always think in real terms. Investments that lost money to offset your gains is free money most people leave on the table. A 1% difference in tax efficiency, compounded over 30 years, can mean hundreds of thousands of dollars. Tax laws vary by country, but the principle is universal. Optimize your taxes. This might be the most important slide for your actual returns. Your brain evolved to survive on the savannah, not to make rational financial decisions. Loss aversion means a 10% loss feels twice as painful as a 10% gain feels good. So you sell at the bottom and buy at the top, the exact opposite of what you should do. Recency bias makes you think whatever happened recently will continue forever. Bull market, you think stocks only go up. Crash, you think it's the end of the world. The antidote is automation. Take your emotions out of it. Set up automatic investments, write your rules in advance, and don't check your portfolio every day. The best investors aren't geniuses, they're the ones who can sit still. Let's tie it all together. Here are the 10 rules. 1. Spend less than you earn. That's cash flow. 2. Invest the difference as early as possible. That's compounding working for you. 3. Diversify broadly using index funds. 4. Minimize fees and taxes. They're the silent killers. 5. Use leverage very carefully. 6. Ignore the noise and your emotions. 7. Always think in inflation-adjusted terms. 8. Build assets and cut liabilities. 9. Make yourself scarce and valuable. And 10. Be patient. Wealth is built over decades, not days. None of this is complicated. The hard part is doing it consistently. And here's the most important thing I can tell you. The gap between knowing these concepts and actually applying them, that's where all the money is. Most people know they should invest. Most people know they should spend less, but they don't do it. So start today. Set up an automatic investment into an index fund. Track your cash flow, max out your tax-advantaged accounts, and then be patient. It's boring, but boring works. If you found this useful, hit like and subscribe. Thanks for watching.